subject because I believe the way to true riches is through investing and understanding the great people in this country that have done so well. They've been investors. They find a way to invest. And I really believe, like, really, if you go back to the history of time, when this country was being, manifested, it was all about people fighting for land and looking for land, all of that. And all of that that's because that's where wealth comes from. The great families of today are people that own lots of land or lots of real estate holdings. But I understand that that's not in line for everybody, but we all got to start somewhere. So either it's a small thing, and our whole conversation today is to kind of let people understand that value still, it still works in today's world. And yes, real estate has gone up quite a lot, and we'll talk in the end. I have some people here that's going to share with us how it's still possible to do something in today's world. Okay. Let me start. I think we actually have so first of all, I wanted to encourage everybody to stay to the end. We are going to have a raffle. You can pick your choice of Universal Studio tickets or a gas card, but you got to stay to the end to get a chance to win that, for our participants. All right. So welcome. We're going to talk about real estate investment workshop. What does it take to invest in real estate? Does it make sense? We're just going to have conversation around that. All right. So my name is Gary with the Gary Nix team. I've been doing this for close to 20 years now. And my co-presenter, who is going to share a lot of insights in the financial world, is Fernando Diaz with Ownbridge Financial. Let's take a little about each. I guess we're just going to get right into it. So why are we here today? What has caused us to start thinking about investing in real estate, and why am I here? Our presentation comes from this book. You guys can see Millionaire Real Estate Investor, written by Gary Keller, top-selling book. A lot of people use this book like a Bible into investment, okay? So the goal here is to share some of my thoughts on money, life, and investing in real estate. It's really as simple as that. Not just my thoughts, but we're going to have some people on the line that we're going to hear what they have to say about this subject. So what we want to first start is cover the, what are we going to cover in this workshop? The possibilities. What are our possibilities when we're thinking like this, right? And then we're going to talk about the power of leverage and the proven systems. The proven system is something that's been done before. A lot of people like to invent, which is great, but if there's a model for a success in an area, it's really good to follow through that model so you can just be as successful. And then maybe once you follow that model, you can modify a little bit to your own liking, your own taste. That's cool. But don't just go do your own thing that's not been done before, because then you don't know if you're going to stand on the right footing or if you have a pathway to actual living successful. Okay. All right, so myself, I'm a broker associate, meaning I have a broker license. I am working under a brokerage. I'm really awesome in what I do, and you'll feel the passion in my conversation today. Let's have, so we're gonna talk about the possibilities. What are the possibilities? The on-hand income to finance your life mission without having to work. That's really what this possibility creates for us. If we can do something that that thing is going on by itself and we don't have to keep working for it. That's a great place to be, and that's our whole thought here. Like, okay, what can I do about my retirement? There's some people are like, oh, they're gonna retire at 43, because at 43 they have created a world where money is coming to them without having to work, and that's what real estate really does for you. Anything else you can do, you can think of to do to create that, you have some genius that create an app, and the app is successful. They'll sell it to somebody, they're getting royalties from it, whatever that is, that you can create where you don't have to go to work every day. You can choose to work because you choose to work, right? It's not that you have to work. That's what the possibilities is in here. And we want to talk about the 8 myth understandings between you and financial wealth. So I'm going to have Fernando help me along this area, just to help me read each the myth, okay? So first, let's talk about the 3 personal myths. These are the personal hindrance, so to speak, that prevent us from moving forward. So Fernando, if you can help me, myth number 1.
Ooh, that's not, yeah. Well, unless you have a fantastic job with a great benefits package, odds are your job is not going to cut it for you in life. So that's where real estate comes in, guys. I actually own many properties myself, and I've been doing or in the real estate business for about 27 years. And what I can tell you is people that own real estate, whether it be just their own home and or investment properties, also by far exceed more wealth and have a better retirement down the road than somebody that rents all their lives or doesn't own property. So that's pretty much covers myth number 1.
Okay. So in a nutshell, you don't need to be an investor. If you think your job will take care of your financial wealth, the answer to that is no, that's not true. You do need to be an investor. Your job is not your financial wealth. Wealth comes from what he was talking about. Let's go to myth number 2.
I don't need to be. I don't need. Well, that's a personal choice. I mean, if that's the case, then some people are happy, with very little, and don't need a lot. But obviously, the problem is in life, you're going to realize as you get older, and things change in your life, and maybe you get sick and you need some care, or et cetera, who is going to take care of you? And the number 1 answer is you. So that's why I believe that in number 2 to me is not really relevant, at least the way I look at things.
Okay, so let me interpret that again. When we think we don't need or want to be financially wealthy, I'm happy with, you're happy being, mediocre or whatever it is that you are at. But the truth is, if you open your eyes, there are possibilities out there for you to create wealth for yourself and your family. And I think a lot of people are thinking on the personal level, right? Like, okay, maybe I don't need much. Well, maybe in your own world. I used to take a coaching class, and they would give me this exercise to spend money anywhere I want. Write it down. You spend money anywhere you want. And in the beginning of those exercises, I always think in very little terms of, okay, pay for my kids' school, go on vacation. And it always limits what I can think with that money. And as I started doing that exercise more and more, I started to think bigger, like, how about go to a game? How about create a mission? One of my personal thing is, as most people know, I have a special needs person in my household. And, so I'm thinking, okay, what can I create a big environment for special needs people? And my daughter is kind of like in between really, really special needs and independent people. And, so what can I create a school for that? And that's what you have with football players, basketball players, even movie stars that does so well, they think outside of the box. There was a famous player, Latrell Sprewell with Golden State Warriors back then. Great player. And he was negotiating contract at one point, and he was talking about, I want my money. I want to feed my family, right? And he got paid, you know, I don't know, 10 million back then, which looked like a lot of money back then. But, you know, a few years after the guy retired, he was broke because all he was thinking was himself, the money that he wants to get for himself. Whereas you see all these other guys that they expand their mind and they want to do things for the community. They want to do things for the environment. And those guys continue to strive well because they think beyond themselves. All right. Third myth. It doesn't matter if I want or need it, I just can't do it. And the truth about that is you can predict what you can or cannot do until you try. You got to give it a shot. And giving it a shot is really knowledge. Knowledge is power. The Bible talk about people die for lack of wisdom. It's getting that wisdom and then acting upon it. All right, so we're going to go to the investing myth. Let me see. Is Laurent over here? No? Okay. All right. Let's move forward with that. Investing is complicated. Okay, so maybe you can make comment on that, Fernando. Help us on that. Just with the answer and just put some comments around the answer.
Well, yeah, that's basically it. Investing is only as complicated as you make it. But obviously, just like your other myth said before, you know, if you don't try to do something or create something, nothing's going to happen. So that's right on point.
All right. And myth number 2, the best investment requires knowledge most people don't have. Can you respond to us? Give us the truth on that.
Investments being in areas you can or already understand. Well, I truly believe I don't invest in things that I don't know, whether it's real estate, if I don't understand the property itself or the area, and or stocks, same thing. I don't invest in things that, you know, like Bitcoin and all that stuff. And I know a lot of people have gotten wealthy from it. And then a lot of people lost a lot, you know, in this last crash I just had. So I stick to what I know.
Okay. Investing is risky. I'll lose money. This is a myth that a lot of people have, right?
Well, I would say that at least in real estate, if you look at it over the long run, it's very hard to lose money over the long run.
Yeah, you may not make money in the beginning, and we'll talk about the different models at the end where, when you invest, we'll talk about that. You know, some investment, you have to be calculative in it. Some people will make a decision on looking at the long run possibility of what they get, where other people look at, no, I got to have something today. You know, we'll talk about that. Okay. Successful investors are able to time the market. All right. What's the truth on that?
I think that's hit and miss. You know, like I said, if you're playing the long game in investments, typically, you know, your investments will come out in a very positive fashion in the long game.
Yeah, absolutely. Okay. And myth number 5, all good investments are taken.
Nope.
That's not right, because again, it's finding those possibilities. I can't wait for us to get to the Q&A session of this seminar, because that's when we're going to really explore all the possibilities of what one can do in different situations. All right. Okay, so just wanted to give you some facts. You know, this is from National Association of Realtors, right? 17% of all 1 to 4 unit homes, that means either a single family home, a duplex, a triplex, or fourplex, purchased in 2010, involve an investor as a buyer. Okay, only 17%. So that means 83% are regular home buyers that bought them. Okay. Now, 68% of all investors buy within 50 miles of their primary residence. That is true. What comments do you have about that? To buying within 50 miles or as opposed to buying out of state and that kind of stuff?
Well, I mean, I think that like everything that I own is here in Southern California, which I like, obviously the proximity to everything, just in case something were to happen or you need to see something. But the only thing with buying out of state or, at a distance that's too difficult to get is it typically you incur a little bit more costs because you have to have somebody watch over it from the, that's closer to the property. So that's it. But obviously if the numbers make sense, that small cost of doing that shouldn't impede you from, doing something out of state or further away than you think.
Yeah. So, I mean, the key thing is 68% of investors, not 100% of investors buy within 50 miles. You just got to look at what makes sense to you, right? It's all about the numbers when it comes to investment. Does a number work well for you? And then that's why we talk about the long game or the right now game. We'll talk about that. So average search last year, well, so that's okay. I don't think we can mention that. 63% was single family home houses. So we'll just leave it at that because the average price is like, okay. That's out of the world. Okay. All right. So LA County statistics, again, stuff to know. Number of absentee-owned condos, 95,993. That means people that bought the condo and they don't live there. Of all absentee owners, condos purchased in 2020, 4,353. So there's 4,353 people that are buying property so they can rent it out. Okay, for condos. Of single family homes, the non-owner occupied single family homes, and this is from last year, it's 197,147. So again, that's 197,000 people that's buying. This is LA County. This is not California, okay? Number of absentee owned single family purchase in 2020 was 11,183, right? I'm proud to say I'm one of those too. Statistic number 3, this is regarding to 2 to 4 units. There's that's what we call a duplex, a triplex, and fourplex. 92,742 owned, and the one purchased in 2020 is 2,550, right? So we want you to see that people are doing this because it's a formula that works, right? And you can see yourself as one of those. I'm even talking to a young man right now that's looking to buy. He lives in a penthouse. He's renting a penthouse, but he loves the life. So I'm like, okay, let's go get you an investment property so you can grow somewhat. And we're working on that for the young man. Okay. So discover your big why. What could be the big why we do this? Why we want you to look at these possibilities, right? Okay. First of all, is the big goals, specific measurable targets that fulfill your big why. It's always like that. You have to have a good reason to want to do something. I'm really like, I'll do some little things for myself, but I don't really like myself, I don't know, that much. I won't do that much for myself. But I'll do a whole lot for my family, for my wife, for my daughters, right? I'll do a whole lot for them. I'll do a whole lot for a community, for my high school, my college, whatever that is. There's just more to do for those than you do for yourself. So you got to know what your big why is. And then we're going to talk about models, proven systems and strategies for reaching those goals, right? And the habit, the consistent action and right choice that come from following the big models, okay? It might all sound pretty, stocky out there, but just follow along with us here. So the power of leverage, there are unique propositions of investing in real estate in contrast to stocks, mutual funds, and money market, right? Stocks, mutual funds, and money market, you're gonna put your money into it, and then you'll see what your money can produce for you, right? You can make some money off of that for sure. And there are people that go through that model, all right? But real property is an able investment. Its value never goes to zero. You can purchase $1 million stocks and it goes to zero at any time, right? I mean, you can also make a whole lot of money, right? So that's the game you're playing to time it, to make sure it's still making you money, or sell it and buy another one. But real estate would never go to zero. A building that's in some place, even if it's in Texas, in the remote area of Texas, it's still not going to go to zero, right? Purchasing real property can be leveraged. And we'll talk about that, in today's world, how the leverage can work. It can be used like stock in today's world, because to make the return, it's not as easy as it used to be. Okay. What happened to my computer?
Jerry, can you hear me?
Yeah, now I can.
Okay, I could hear you guys, but I couldn't speak. So I fixed the mic. It was a problem with my mute.
Oh, okay. All right. And we still don't see your video, but that's cool.
Okay.
You can click on the video too. Okay. So the power of leverage, a most able investment. Okay, so 7 things to leveraging. Leverage is, instead of you doing the work, you're having some people do the work for you. So it's accessible. Anybody can buy. Appreciable. Actually, let me get Fernando input on this. So talking about the leverage, can you just go through the 1 to 7 and kind of break it down so people get a different perspective of it?
Yeah, hang on a second here. So basically what Gary's saying is, leveraging not only yourself, any properties you currently own, and or using others and their knowledge to leverage, to obtain real estate is really what he's talking about. So in my case, for example, I started, when I was 26 years old, buying properties, and I would use, buy one, fix it up a little bit, get it rented, and take some money out of it, and then I would buy another one, and repeat and buy another one, and repeat, and then sometimes I didn't have to, because I maybe saved enough just to get to another one. But basically, yeah, using the properties to obtain other properties, and then over time to watch them grow in terms of value, and also the rents, as you guys know right now. I mean, I don't think rents have ever been higher than they are right now in LA County in history. Obviously have helped all that. One of the things that, we didn't mention before, but the way I look at this was in the previous slide, about mutual funds, stocks, and all those things. For the most part, yeah, they go up and down over time, and you can become very wealthy, obviously, over time with it. But one of the things that real estate has done for me also is not only does it go up over time and sometimes down, but it's always paying you rent every month, and there's always cash flow, there's always money coming, which stocks don't do that necessarily for you. Your stock maybe went from $10 to 15, but what did it pay you this month? Unless you sell it, right? And then you got to pay a capital gains. But real estate continues to pay me every month, regardless of what the values are doing, even though they've come up, obviously, for me over the last 10, 15, 20 years. So something to keep in mind over the long run. That's, I think, more powerful on the real estate side than it is on the stock side, is that you're constantly getting paid by real estate, regardless of where the value is.
So it's also improvable. It continues to increase in value, deductible, depreciable, and deferrable. So all of that benefits from your taxes, right? And it's stable, meaning it's slow to rise and slow to fall. Most of the time, even if there's a hard fall, it's going to come back. If you look in the last 40 years, real estate has still appreciate on a national average of 4%. Now in LA County, it's more like 6% in the last 40 years. So even though we've had this up and down, situation, bottom line is, if you bought a home 40 years ago, today that home is worth, 3 times more, because of the 6% average that is gone over time. And it's always livable, right? People live in the house. That's why you continue to enjoy the value of it. It's not something that goes away because the trend changes and all that.
No.
So let's
And then
look at the
another thing,
different.
Gary, that I will tell you is I've got a lot of people that I've obviously advised over the years, and they sometimes say, "Hey, am I doing the right thing? Or am I buying at the right time?" Et cetera, et cetera. What I always tell them is this: whatever it is that you're going to buy today, let's just say you're going to buy this house for 700,000. I go, in 10 years, I'll make you a bet. I will buy it back from you for 700,000, no matter what happens. And nobody has yet taken me up on that offer, because they all know that over the long run, it's going to go up. So I'm still waiting for somebody to take me up on it.
So let's take a quick look of how investment works, right? If you look at the chart on the screen, you see stocks, you see mutual funds, you see money market. You got to put money into them, right? And so it's real estate. But let's assume 100,000. It can be, that top number can be anything. It can be $1 million, 500,000, whatever that is. But the key to know is for all those first three, you got to put the whole money into it. And with real estate, you don't. Now, that's kind of changing because market's gone up. To appreciate but just think about it. If you put 100,000 on a stock, right, and you buy a house anywhere in the United States for 100,000, and you can still find them out there. Well, with mutual stocks, you're still kind of betting that you bought the right kind of stock, right? That it's going up and down, right? When you buy a house for 100,000 and you say, let's say you rent it for $800, well, that $800 is going to keep coming to you, for as long as it is, right? And then if you increase the rent, it's going to be more. And then over time, it's going to appreciate. That's really the bottom line of this. You can see how, a mutual stock can be up 1 year, 10%, 8%. Generally, with real estate, like I said, the appreciation level is about 5 to 10%, 4 to 6%, really. However, you're still collecting money off of it, and you didn't have to put the whole money up front to get it. Laurent, because you're a pretty good investor yourself, is there any comment you want to make on this?
Sure. I want to pretty much piggyback off of what Mr. Fernandez said earlier. For me, I started 19 years ago. I started with my first property. It was a duplex down in Long Beach area. And with the purchase of that duplex, it allowed me to purchase another property, which was in Hawthorne, a 5-unit commercial building. With that being said, that commercial building allowed me to purchase 2 more properties over the years. Mm-hmm. So pretty much what Mr. Fernandez said is true. It's true. I just give a little detail about my personal business. I was working, and my company matched our stocks, our mutual funds, or what have you. And I took some money on my retirement, and with that money, it got me started. It got me started with the first piece of property, and then everything just snowballed from there.
That's a beautiful thing. I still remember I met this one old Jewish man when I first, before I got into this business, actually. And he gave me an advice that it stuck in my head forever. I helped him, purchase a bunch of stuff. And I'm like, this man bought a lot of stuff for me. I used to work in retail then. And I'm like, who are you that bought, almost $25,000 worth of stuff? And he bought everything for people that work for him. And he said, son, can I give you an advice before I tell you who I am? I said, sure. He said, I want you to go help people with real estate. I said, really? And what he observed is that I was really good in helping him with everything that he was looking for. And he felt the passion in me to make him understand what he's buying and all that stuff. So he said, if you go do that for real estate, because even though these are nice cameras and lighting and all that stuff, but he said, you will change people's life. I said, really? He said, yeah. He said, it doesn't matter if it's a hole in the wall, you first help them to buy. It can start by changing their life. And it took me a minute to understand that in my process of doing what I do. But I get it, especially when I read his story. Even though it was a Jewish white guy, his parents were like farmers, and they didn't have a home. They just had a what do you call it? A mobile home. I mean, a drivable. What do you call those drivable?
RV, like a recreational,
yeah, like an RV.
trailer.
Yeah,
trailer.
That's what they had. So they were always working for a big plantation owner in the South, and him and his brothers will help them with the farm. And then as soon as their parents set up the farm and everything is good, the owner of the plantation will kick them out and get slaves to work the farm. So the kids now go with their parents, they haul their trailer to another park, and they start working for somebody else. So when they go to school, they're out of school, because when they first get to the new place, they got to help their parents with setting up the farm and all that stuff. And he just made up his mind that he's going to keep doing whatever he can to go to college on scholarship and save and work while he's in college to save enough to buy land. And it's all concept, like most of us do, is to just buy a land for our family. It was tired of his parents being moved from one place to the other. And as a matter of fact, of all his siblings, he was the only one that was studious enough to make it in school, because, when they go to another piece of land, the kids have already missed school. By the time they go back to school, they're way behind, and they're always shy. But he was always studying. No matter how much they work in the farm, he would go back and study to keep up pace with his level of education. And that's what this man did. He bought a piece of land really for his family, went back to New York, and by the time I read the story, he became the 64th richest man in America.
Wow.
And it all starts with that buying that piece of land, many years later they sold that land, and you just read the story. It's like, wow, David Murdock. Anybody can check him out. I don't know where he is in the I ranking of wealth now, but I'm sure it's still up there, because at that time it was worth like a lot of money for sure. So we're talking about leverage, using other people's money, banks, mortgage companies, and owner finances to make money. Leverage multiplies your profit. Appreciation and rent are based on total value of property, and return on investment is calculated by money invested, 20% or whatever the amount is. So it's kind of a calculation, not taking rent into consideration, assuming property went up 5%. If you stick to your model, right, when buying, this is conservative. Like I said, in the LA area, it's really about 6%. Most of the country is around 4 to 5%, right? So if a property is worth $100,000, 5% is $5,000, and $5,000. Let's say you put 20%, $20,000 down to buy that $100,000 property. That's 25% of the value of the property. So to make money, when you in this sample, if it was like a mutual fund, you will need to have $250,000 cash to make that $20,000. But here you're only putting your $20,000 in on a $100,000 model, right? Of course, today's world, you could be buying $800,000 property or more. Okay, so let's take a look at that. Okay, in the top part of this chart, money is working for you. In the lower part, you are working for the money, right? And financial wealth is built on the top part where the money is working for you. So just look at this, your consumption, your cash flow, and then, on the other hand, at the top is where you are getting the same thing, but you ain't working for it. You know, you just set it up, right? Let's go to another chart. So financial model, equity buildup. So when you first buy a property, you owe a lot of debt, right? That's just typical. And then you put some money into it. That's your investment. And then you have a little equity. So let's say you put 25% down. That's your equity on the property, right? But you still owe a lot of debt. You know, you buy a $500,000 home, you put 25% down. That's like $100,000. You still owe $400,000. That's the big red stuff. But let's see how that moves up, right? As time goes on, you know, 5-10 years down the road, your debts start coming down and your value start rising. Your investment that you initially invested is still the same, right? But all of a sudden now you're having more equity, right? And look at that, your debts are going down again. You know, 20 years down the line, all of a sudden, you know, that $500,000 home, maybe you owe $100,000 on it. But now that $500,000 home is worth $1 million, right? So you have a lot of equity. Still same little investment you put into it. Well, by the end, you have no more debt, your little investment, and a lot of equity. That's where money comes from. You know, when you go to, let me see where we are. Oh, Lord Jesus, we need to move. Okay. All right, so let's now look at the rent and where you make money. So that's what you just saw before was a chart that shows how your wealth develop. The top, I think 2% of America are people that owe 2 million or more in wealth besides their personal property. So you are in the top 2%. If you have $2 million in wealth, whatever that equity is, that's your wealth, right? So now let's look at this other formula here. This is rent and how you grow your cash flow, right? So again, you have a little cash flow. Maybe you bought a property, you have a mortgage, and you have a little return. You know, maybe you're just making $200 in return or $500 return, right? And again, as time goes on, you have the debt service. That means whatever you're paying for the mortgage, whatever you're paying for utilities and all that stuff, right? You have vacancy and expenses, and you have your cash flow start growing, right? And this is money that's coming to you now, okay? Expenses still the same. You still have the little debt, and you have more money coming in because now you're not paying any mortgage or you're paying less mortgage, right? And by the time it's end, you have no expenses, right? All you have is a vacancy and, you know, with people coming in and out. And if it's a single family home, this is where we look at models where, okay, do I want to buy a single family home? Do I want to buy an income property? We'll talk about that in a minute. But this is how your money continues to grow for you, you know, once it's paid off, right? All right. So why do people invest in real estate? It's number one, is return investment, less out of pocket for more into pocket. Tax write-offs, it grows your net worth through equity. So yeah, you can save money, but it's tough to save enough. I always tell people, you can't save enough, then a property can appreciate for you, right? And because you can't touch it all the time, you have to go through refi and all that stuff to touch it. It's not easily touchable. You know, I don't know how many times I've had 50,000 or 30,000 in my account, and something comes up, I gotta put, you know, shell out 5,000. I gotta shell out this other 5,000. Even, you know, you're doing community service, you help out with this, you help out with that. That money goes up and down. But when it's in the equity, you can't touch it. You can't touch it. You know, at least it's not as easy to touch it. So you don't want to bother yourself to touch it. And that thing keeps growing for you, right? So let's move on because I still have a lot of slides to show. I need to move. So tax write-offs. In your tax write-off, you can write off operating expenses, mortgage interest, financial costs, any miscellaneous costs, maybe fixing the property, improvement, personal property you buy. It's just so much stuff you can write off legitimately, okay? It doesn't cost you your income, right? This is what I hate to say. Our ex-president, it was a very popular one, Donald Trump. This is why he does so well. Even though he has billions, he didn't pay no taxes because he write everything off, right? And that's why everybody was putting in their account like, let's show your taxes. It's like, hell no, I'm not showing my taxes because they make a whole lot of money and they write everything off, right? Typical with, it's really a model for business people. It's not, that somebody is bad or anything like that. Okay, so this is kind of my story. I think we've been hearing about it. I got a lot to cover. Kind of like Fernando and Laurent was talking about, we all start from somewhere, right? I still go back to that old man that I met that, got me started, and I've fallen through the cracks. I've lost some of, my first investment, I lost it and lost a whole bunch. But you stay in it, because if you stay in it, you'll continue, you eventually grow in it. And that's happened for us. Okay, so let's look at the different, you all heard Laurent talk about, it started with income property, right? I just want to give you guys a guideline to either one of this. Either you go with a condo, a single family home, a duplex, or fourplex. What are the differences there? Let's look at the condo. So the pros and cons is lower purchase price than a home in an area, usually. Maintenance is included for most of the outside stuff, right? Just a little part you have to deal with. More amenities for the tenant, besides what is in the condo. They may have a pool, they may have a lawn tennis court, they may have all these different things. They may even have a gym, in that condo, right? So the cons is that usually you'll deal with HOA fees that can rise from time to time, right? And less appreciation typically than a single family home, right? But I don't know, in today's world, everybody appreciate. I really tell people, it doesn't matter, they do appreciate, okay? Let's look at single family home. Easier to resell, right? It's usually just one person, they move out, it's easy for you to resell it. Typically surrounded by owner occupants. So the environment foster for people to be, the tenants to maintain it a little bit better. And it will give you more appreciation. The only major negative here is that only one unit to generate income. If you have a loss, or I have a tenant, I hate to say it right now, that hasn't paid me for 6 months, and wow, that can hit your profit alive, right? So those are disadvantage on the single family. Again, I always like for things to speak to you where you are and connect with that and then roll with that. Duplex, obviously, usually close to single family homes, so they are always in a nice kind of a neighborhood. And some people feel like they still owner occupied because they have their own space with a duplex, right? More cash flow than a single family home because you have 2 units that's paying you, and doesn't appreciate as much. The key thing is with a duplex, it's, well, let's just stay with it. Let me not do much talking. Oh my God. Okay. All right. Let's move on to a fourplex. Again, a higher cash flow, right? Minimal financial impact. If somebody is paying, you still got 3 people paying. You're probably still making your mortgage easily. You may just lose. And by the way, that one property I have, even though it's a single standalone property, I have another one in the front, which pays my mortgage. This one was my profit one that, the tenant is, been tenant from hell. All right, so more upkeep in a 4 unit, and then you have to deal with a lot of conflicts. Oh my God. So, you have to know who you are. If you don't like to deal with conflicts, this is not for you. Or you just hire
Property management.
a property manager company to handle it for you. All right. This is where you got to know. You may have to cut down that profit a little bit by hiring a property manager so they handle the conflicts for you. Okay. So the key thing is know your value, find the opportunity, and make deals happen. Right? Everything is. We share this with you to kind of get a vision of what's out there and what will speak to you where you are, so you can decide which is the way you want to go. Okay. So a mortgage, for example, is a 30-year to 15-year, 20% down or more. I'm gonna get Fernando is it's been in the financing business for a long time. It helps a lot of our clients. So we're gonna talk a little bit about this in a few minutes. I just want to go through the slide because I'm running out of time. So your first property and your next property, what are the things to expect? We're going to talk about the qualifying issue, especially in today's world, but just bear with me to go through the slides. What happened here? Okay. So property management versus self-management. This is where you got to know who you are, all right? Can you deal with people? Can you deal with, especially if you're in a multi-unit, there's always going to be conflict. I mean, very seldom you don't have any. So can you handle that? Do you want to manage it? Don't create stress for yourself. Create a life by design for yourself. And you can set it up well. And I'll give some ideas of how you can set up if you decide you want to manage things yourself. All right. So we're going to talk to a mortgage professional, and let's get, if you have questions about this, like, okay, how do I do this? Now, first of all, I want you guys to know that the reason why we show you this, number one, because some people, maybe this is their first time looking to buy a home, right? We want to validate that for you, because when you're buying that home, again, you're paying down the mortgage, you'll have the opportunity to write it off and all that stuff. You are creating that wealth for yourself, right? And this is to encourage you that what can you do to the next step? So Fernando, I'm gonna take off the slide for a minute so you can come in. Oh, here you go. We still have, so you come in and tell us about, in today's world, how can we finance real estate? What are the challenges that we face? Is something still possible? How can, because, obviously prices have risen up a lot more. But if really, again, if you look at the 40-year average, we just went a little over the 4%. And in LA County, we've always gone over the 4%. So even national average, we just went a little bit over. So if there's a correction, it's going to be a slight correction to bring us right back to that 4% model year over year. All right. So it looks like, things have gone up, but the truth is people are making a whole lot more money than they used to make. An average American family 10 years ago used to make $60,000 per household. I know it's got to be over $100,000 per household now, because I just know I deal with the average family and I see the income is changed different. So we're making more money than we used to make. So it looks like, oh, things have gone up, it just is where we are. I mean, property has not gone up as gas has gone up. Gas has gone up crazy. All right, talk to us. What are this benefit? Fernando, talk about us about what's going on over the years and all that.
Well, as you guys can see here by this slide that Gary has, you can see the average 30-year fix since 1974. And if you look at where we're at today, let's just say somewhere in the mid fives, historically speaking, we're in a great place, historically speaking. Obviously, people's psyches, people are spoiled because we went off historic lows over, last year and coming into the beginning of this year. But like Gary says, that's more of a mental block or an emotional state that people are in. He is right. Family household income has never been higher. Even if you go back through all these years, you see on this chart, though the rates were much, much higher, keep in mind people's incomes for the most part were way, way lower. Family income was way, way lower. And obviously the prices have adjusted since, for whether it be inflation, growth, appreciation, et cetera, et cetera. But the reality is in the long run, and I think, I don't know the name of your client, Gary, that has bought some real estate too, that was talking earlier.
Laurent.
I don't know anybody in the history of my, being in this business for almost 30 years that hasn't just been so grateful and thankful for what real estate has done for them, myself included. I mean, I would not be in a position or the position I'm in today, or at least as I get, I just crossed 50 years old here in May. But as I look, let's say another 5 or 10 years out, if it wasn't for the real estate that I took a risk on, bought, fixed, and, just kept, it just, my life would be very different. It would not be, I wouldn't feel as secure as I feel going into my 60s, shall we say, as I approach them, getting up there. So I don't know if anybody has any questions, in general about this, but that's, my personal opinion of how I feel,
Okay, so give us this other edge, what you guys do, because again, a concern, and we're going to do good through Q&A now, by the way, if anybody.
Well, this flyer here, guys, is our builder division. I don't know if you know, when you buy a new property in the tract, typically you may buy something today, put in some of the amenities you choose, some customization, and then they'll say, okay, well, this phase of homes won't be ready for another 6 to 12 months. So what we did is we took some of the models that they use. They lock you in. It's called the lock and shop product. And they would lock you in. And then in 6 months, 9 months, whenever you took possession of your house, that was your guaranteed interest rate. Okay. Because the builders would pay for that cost. Okay. So if you look at what happened since January to now, that would have been a huge benefit for a lot of people that didn't lock, because let's just say on January 1st, rates were 3%. And today, let's just say they're about 5.5%, give or take. And a lot, if you look at last month in the news, 15% of all transactions nationally canceled. And I have a feeling a lot of it was builder business that wasn't locked in. So this program here gives you guys peace of mind, because you can lock now and shop with confidence. And also, if you're going to sell to buy, let's say you're going to trade something up or whatever it may be, you can lock and get your property ready to sell. And then also, once again, start looking with confidence, knowing that this is the worst you're going to do. Because when you're locked in, that is the worst you're going to do. We have a float down policy in place. So also, if the market were to dramatically improve, we could take advantage of it. And secondly, or thirdly, I would say, if there's a better product that exists at the time that you're actually in escrow, we could potentially switch it over to that one and leave this one here if it benefits you. So it's basically one of those programs where it's hard to lose with a lock and shop product.
Okay, so let's talk about into this world. I think without a doubt, the system the government has, for income properties is much more tougher. 25% down on people trying to buy their second home. What are the ways that one can go about it? I just want people to see the possibility. First of all, if I'm a young family, we own a home right now, we've had it for 5 years, whatever, and we decide, hey, we'd like to buy that second property. How can we, what is there for us where we don't have to come up with 25% down, because we don't have the 25% down? How do we do that? And obviously you can't tell people to refinance right now with the rate so high, and then lose.
No, but at that point, you have to also look at potentially trading the property you have and using the equity that you built there to go for something else. Because I've done that at times, and what's happened is, the equity for the new one, because maybe it's in a better area, better schools, et cetera, you get more appreciation over the long run. So you're basically just moving that sitting equity that you can't really touch because it's basically tied into your current home, and putting it into another asset that, potentially could have more appreciation over the long run. And then now that, has expanded or created more wealth for you over time. So that's one thing you could do in terms of if you don't have the 25% down, you could do that. Or maybe 401ks and different things that you may have that some people don't think of that you could also use or, borrow against or cash out of to put it towards real estate. That's another thing you could potentially look at too.
And that's actually a good thought. I know Laurent talked about that earlier on, that taking money from his 401k. And let me just give people an idea. I remember, my wife and she had the 401k at one time. and she still have it now. But you know, our first investment, it was basically my daughter was going to a school, UC Riverside, and we went there to look for rentals. And I'm looking at the room rental was like $920 for a little bed in a room. So I'm like, okay, what are homes costing over here? And I had to convince her. I said, listen, you know, what if we take some money from your 401k? Because I had liquidated my 401k, you know, due to some family emergency we had. So I said, okay, let's take some of your 401k and use it to put down for this property. And she said, why are you going to do that? You know, how is my retirement going to be protected? And I had to show her, I said, listen, let's look back the last 3 years. How much have you built it up on? So if we take this, at that time, we only need like $50,000 to buy that property. If we take that out and we go use to buy this property, and number one, we will not be spending $900 for room that we're going to spend for my daughter. We'll actually be making money off of that. And we did that, and it paid off, you know, tremendously. Not only, it turns out my daughter decided she's not going to that school. He decided I won't go to that school right while we're funding the loan. But we kept it on, and we had a cash flow of $500. So I'm like, okay, we pay your 401k back, and it worked out really good. And that property appreciates so well that when I sold it, I don't know, 8 years later, to move it further west where we have a better return, kind of like what you're saying, that you sell it and you go buy something that produces you more wealth. So that's all possible. What I wanted to have people look at is, okay, they own a home. How can they buy that second home besides the 401k? If you're a couple, maybe one person had a home on their name, well, the second person can go buy another home as owner occupied. Really, the key is to find ways to qualify for owner occupied on another property, because as owner occupied, at least you get the best rate and you have the least amount of down payment.
True.
And if not, you can even buy it with your daughter or your son, and still buy it as owner occupied.
Yeah, one quick thing there, guys. This is a big misconception that's out there. Let's just say that you have a daughter or son that's in school and not working, but it makes sense. Maybe you're buying something near the university or near the school or whatever it may be. They don't have to have a job, as long as you can qualify on your own, the husband and wife, together or by themselves, that your child doesn't even have to have a job. They're just the occupant of the home, and they don't have to bring any income into the table basically to qualify. So you can do it that way too, which means if your son or daughter doesn't work, it's fine.
You just open my eardrums up right there. So if they have the daughter or son in there, they can still buy it owner occupied because the other person is going to be occupying it. Is that what you're saying?
Yep. And also, the only thing that's important is the person's credit. We're not even putting employment or anything on the application. The parents are qualifying basically for the whole thing, but they have to be on the loan, obviously, for occupancy reasons, and that's all it is. So as long as they don't have extreme amounts of debt and their credit is in good standing, you're fine.
Wow. Wow. This is something, this is why everybody's got to be open to understanding stuff. This is a new concept for me even now. My mind is walking through right there. Like, wow. I think this is really great news for a lot of people, because today to buy non-owner occupied is just a killer. 6.75, even 7% interest rate. So if you can have a family member that's got good credit, or if they don't, we can make them establish credit pretty quick. And obviously they have to be mature, over 18 years old.
Yep.
And if your income can qualify them, so this is really a good concept for people to understand. Again, it's
1 second. I'll be right back here.
Yeah, that's cool. It's about growing the wealth of everybody. The family wealth is what I say. How do we create a legacy for family? So if the income is good for you and you can go add this other person and add that other person in there, I think that's a great thing to know. All right, I think